Welcome back, everybody. Mark is here with a real estate market update for the greater Milwaukee area, this time March 2022. A little different format here today because I'm traveling, but we have so much new information that I didn't want to wait on sharing with you. Picture here of the Hohen Bridge in the colors of the Ukraine. But the big topic for today that I want to discuss is a question that I'm getting a lot from my clients these days with the market being so hot. Is 2022 a good year? Is it a good time to make a move in real estate, or should I wait until the market cools off a little bit or changes? And it's very difficult for me to answer that question for everybody in general terms because every situation is so different, depends on what you're trying to accomplish. But I want to show you some data and give you some perspective and hopefully help you answer that question a little bit, or at least give you some perspective. But before we go there, let me show you what the latest numbers came in from the MLS here for February 2022. Directionally, as you can see, not much of a change in direction. We have, again, a month with extremely low inventory. You can see here the comparison back from 2015, where we had almost 11,000 houses on the market. Now we have 2,371 houses on the market, and we sold almost 1,500 houses from a very small pool of inventory. And with that, no surprise, prices up already 4.8% this year. The war in the Ukraine did not have a real strong impact on the real estate market. That is my observation from talking to buyers and sellers here on a daily basis in Milwaukee, and that's also what I hear from my sources on that do national analysis. We're not expecting any major impact. What we are seeing is that there is an impact on the mortgage interest rates, and I'm going to talk about that in just a minute here. The market in general this year in January, February, and the first half of March, almost the end of the first quarter, reminds me very much on what we have seen last year in terms of inventory, in terms of competitiveness, and in terms of prices being pushed up. Very much the same thing as last year. The only difference is this year, a lot of people are anticipating mortgage rates going up. They're seeing rates running up and they're afraid that the rates are running away on them. And so that creates a very high sense of urgency on the buyer side. And they're writing very aggressive offers because they want to lock in, they want to buy a property before rates are getting too high. So to answer the question, should you make a move this year or should you wait? So there's a number of things to consider. First of all, it's your personal situation. Are you upgrading to a bigger home? Are you downsizing? Those are things that have to take into account. And then in general, you have 4 points here to consider. What can you expect from home price development? Because you can say, all right, I'm going to hold on to my home a little bit longer because the longer I wait, the higher the value of my home. So I'm likely to get more money when I'm selling my home. But then again, you're also buying a home in the same market. That means that you will likely also have to pay more for a home. So what can we expect from prices this year? Also inventory, the first 8 weeks of the year, inventory was extremely low. Omicron has had an effect on that. So from low inventory, we went to ultra low inventory. This is becoming better now in the last weeks. Then we're going to take a look at interest rates and of course what's going on with inflation and the stock market. All of these things are contributing to your specific answer if 2022 is a good year or is a good time to buy or sell, or if you should wait for a better market. Let's start with pricing. So there was a little bit of a consensus in the market last year that 2022 is going to see a slower version of the market, that price appreciation would slow down. It has become very clear in January and February in Milwaukee that this is not going to happen. We have a very, very competitive market. Buyers are driving up prices. And I have now the data to show that to you on a national basis here from CoreLogic, 19.1% of price appreciation in January 2022 over the January last year. And this is the highest that we've seen so far. So we are definitely into another very, very hot year in real estate in terms of price appreciation. Now, when we look at the total US, you can see here the national average was an increase of 17.5%. And when you look on the map, 13.5% for Wisconsin. So I like the fact that we are not running super hot, red hot as other markets. Look at Florida, for example. Look at Arizona, look at Idaho, all the markets on the West Coast, but also the Southeast, Georgia, South Carolina, North Carolina, Tennessee, even almost 25%. So prices have been going up very, very fast last year. And I personally actually like the fact that Milwaukee or Wisconsin is not here on the forefront of price appreciation. Now let's take a look back and see what happened over the last 5 years. So the national average, 54.5% increase. And when you look at Wisconsin, a little over 51%. So we are right on the national average. The leader here is Idaho with 118%, but Wisconsin here comfortably in the middle. And looking back even further, I have here data from 1991, and you can see national average 258% increase of real estate values in the last 30 years. Milwaukee, Wisconsin is here right around 248. So we are right around the national average. So the question that I always have for people when they say, well, should I buy a house? What's going to happen next 3 months? It's like, when you look at a long-term picture, you can see what's happening with real estate. Would you go back to 1991? Do you think it was a bad idea to buy a house in 1991? And when you look at these numbers. So it's always hard to predict. We don't know what's going to happen here in half a year from now. We can look at the data and we can see, are we getting into bubble territory? Is the market overheating? And every time, I'm an engineer, every time I'm getting emotional, I'm like, no, let's look at the data and see what the data is telling us. So this is a little journey that I want to take you on today. So the worries of the housing bubble still persist. 77% of consumers are worried about that. And even from the agents, 44% of all real estate agents, according to a survey from Realtor.com, are worried that we are getting into a housing bubble. And it's no wonder when you look at what's going on with prices. A good listing in Milwaukee can get 10, 15 offers, all of them over asking price. So it's very, very competitive. Of course, the conclusion has to be, this is going to be a bubble. And I have here some data to show you to really understand, are we getting into bubble territory here? And the first one I want to discuss is inventory. If you've been watching my channel, you probably already know this, but we are measuring inventory in terms of months of supply. So how many months will it take to sell all the inventory that we currently have in the market? And we are talking about a neutral, about a balanced market if we have about 6 months worth of inventory. And the seller's market is less than 6 and the buyer's market is over 7. And when we look at what's going on here, what was going on from 2007 to 2010, we had a lot of inventory back then. It was very visible, almost 10 months of supply in 2007. So we produced a lot of houses that nobody needed, that didn't sell, that were just sitting vacant. People were speculating with houses. Now, when you look at the last 4 years, 2018 to 2021, we are very low on inventory. Again, 6 months of inventory is a balanced market. And the last year we were on the national average at 1.8. So we have very low inventory, and it's not easy for the U.S. housing market to come up with an additional inventory. We'll get to that in a second too. So low inventory also in Milwaukee. We are currently seeing a little bit more in February. We got a little uptick, but we're at about 1 month of inventory. So still far away from 6 months worth of inventory. So from that point of view, we are far away from a potential housing market bubble or from a correction. The next thing to look at is lending standards. So what I have here is some data about loans that were made to people with very low credit scores, 620 and less. And as you will recall, very loose lending standards contributed to the problem that we had in 2006, 2007, because we were issuing a lot of these ninja loans, no income, no asset, no job. So people got issued loans and they bought houses they couldn't afford. They had no job and no income to ever pay the mortgage back, and they were still issued loans. The result of that, you will still remember, lending standards have tightened a lot since then. And the latest number here is we have from 2021, from the third quarter, we have a very low number of loans with a credit score of less than 620. So you do need a job, you do need to show income and assets so you can actually afford the house that you're buying. We have very tight lending standards. Next thing to look here is total home sales. So this shows the velocity of the market. Last year we have sold in the US 6.1 million homes, and that was a new record. We've seen a similar record in the Milwaukee area. So there is very, very strong demand in the market. A lot of millennials turn into their prime home buying years. They get married, they have babies, so now they're in the market to buy a home. They're done renting, they've seen their rent going up every year, and they are ready to buy a home. And once the decision is made, they're usually following through with that. They're not going back to say, oh, never mind, we're just going to keep renting. The reason why we are in the situation that we are is because we have underbuilt new construction for the last 13 consecutive years. You can see here the black line. This is the 50-year average. And it is very clear when you look at this, the 10 years leading up to 2007, we have overbuilt inventory. We had too many houses on the market, too much inventory. Houses were sitting vacant, houses were not selling. There was just too much inventory, fueled by ninja loans, by subprime mortgages, and that of course led to that situation where a lot of builders went out of business and new construction really came to a grinding halt, and we dropped down to a very low level. And we are now short about 5 to 6 million homes in the US, and builders are trying to ramp up production. You can see that also in the Milwaukee area. I was driving around in Waukesha County last week, and it's good to see that more and more subdivisions are springing up there and being developed. But the houses that we're building are too few in numbers. That's just not enough. And most of them are in the $600,000, $700,000 price range. So that doesn't really help us very much with our inventory problem. These houses are just too expensive. Experts are estimating that it will take us about 8 to 10 years for the builders to ramp up production, so we're getting out of that supply shortage. So without a major change, we are going to be in this market for quite a while. Now, what's new with inflation? You can see here the latest numbers from February. Consumer price index came back at 7.9%. And when I'm looking in the chart, I have very little hopes that we're going to see inflation slow down. In fact, with the war in the Ukraine and the impact on the energy sector, fuel prices are going through the roof in Europe, and they're also sharply increasing here in the US. And I don't think we have seen the end of this yet. So we are going to be in for more inflation, which will also have more money looking to get parked in real estate, because real estate is generally known as a hedge against inflation. So in my opinion, that will further increase the fuel, put more fuel on the fire with real estate market. And we'll see how the Fed can try and curb inflation. They're going to certainly try this, but they have to aim for a soft landing because they don't want to choke the economy too much and put us in a recession. So they have to find a really fine balance, curbing inflation, getting it back down to 2 or 3%. And we are running on a way too high level. The US dollar is losing purchasing power way too fast. And that is also a reason why people are trying to put their money into real estate. What's happening with the mortgage rates? So the prediction for this year was actually that we're going to go from 3% to 3.7% by the end of the year. And we have already surpassed the 3.7% goal by the end of February. But what happened is that the war in the Ukraine introduced a level of uncertainty into the market that has an impact on the bond market. Investors are content with lower returns, but with safe returns. Real estate is usually considered safe. So that has an impact on mortgage rates. And we're leveling off. I would have actually expected to be significantly over 4%, and we're at 3.85% at the moment. And from the looks of it, we might go sideways in the short term. And that's good news, because we've seen such an urgency for buyers trying to buy a house, and before the rates are running way too much for them. And so that is a little bit of a relief for buyers. You can take your time, buy a house, because rates are not running away on you. It looks like in the short term, they're going to stay between 3.5% and 4%. And when you look at the long-term picture here, I have the chart for the last 30 years, you can see that the spike that we are currently seeing doesn't even really show up on the chart, because anything below 5% is still historic, very, very low interest rates. I think before we can see interest rates slowing down the market, we have to go significantly over 5%, because once a home buyer has made the decision to buy a house, They didn't make it because the rates are low. They made it because it was the right decision for their family, because they had kids, they needed a better school district, etc. And the rates are what the rates are. So the only impact that rates have is it reduces their affordability, because higher rates mean a higher payment, so they can only qualify for a lesser priced home. So we will see some dampening effects on that side, but rates really have to, when you play with the numbers, 0.5% or 1% doesn't really move the needle that much. Once we hit 5% or 6%, which we're not anticipating at this point, that's a different story. So rates remain on near historic low levels, even if they have gone up a little bit over the last couple of months. And that brings me to affordability. So in the middle of this chart here, we have affordability in the Midwest, and what this is showing you in blue is the median family income, and then in green you have the income that is necessary to buy a median home. So you can see affordability is still very, very good across the board, and the Midwest is actually the best here in terms of affordability. I think with remote work and with the ability for people to move freely, we are going to see more people moving into the Midwest from higher priced markets on the East Coast and on the West Coast. Now, my outlook for the next few months is the market is going to remain very, very difficult, and the challenges are different depending if you're on the buy side or if you're on the sell side. So I think you know that buying a house is a little bit of a challenge right now. The market is super competitive, and we try to do a lot of coaching and front-loading our clients with information so they are well prepared with what to expect when they're going into the buying market. The better your information, the better you're informed, the more you understand it, the more successful you will be. On the sell side, it's actually pretty sweet to be a seller right now, because no matter what you do, you should be able to sell your house. That was not guaranteed 5 years ago. A lot of people were putting the house on the market, couldn't sell it. So the question today is really, can you execute a sale in a way that you're taking the most advantage of this market and get the most amount of money, really maximize the potential that you have to get another $10,000, $20,000 out of your house, because you will need that $10,000, $20,000 when you become a buyer in the same market. You will need that money. So we are very much in a skill-based market here. It really matters on the buy side and on the sell side. You have to execute on a very, very high level. So I hope I was able to give you a little bit of an idea where we're at in the real estate market and what you can expect. I cannot give you general advice if now is a good time for you to buy and sell. It really depends on your personal circumstances, and it's also a very fluid situation. So it's always very, very hard, if not impossible, to predict the future, but I hope at least you got a little bit better information here. If you want to discuss your personal strategy, then feel free to reach out to me. You have my email address, you have my phone number here. I'm happy to jump on a quick Zoom call with you and discuss your personal situation, and if 2022 is a good time for you to either move up or move down or make a change in your real estate life. That's all I had for you today. I hope this was good information. If you have any questions, you can also put them in the comment section below of this video. That's all I had for you, and I'll see you at the next one.